Hello, my name is Mike Smith. I'm the president and founder of T&K Futures and Options Incorporated. And today's video lesson is going to be about the feeder cattle market. But before we get started, let's go ahead and cover the risk. Futures and options investing carries significant risk of loss and is not suitable for some investors. Past performance is not indicative of future results. And you should only use risk capital when investing in these types of investments. Okay. I've been doing this now for 20 something years as a commodity trader, and I hear a lot of questions from investors time and time again. It ends up being the same group of questions that I hear. So what we're going to cover today is just the 5 most popular, I guess you'd say, questions that I hear as they pertain to the feeder cattle market. The first question that I typically get is, how do futures contracts and margin work? Well, margin is a good faith deposit that you have to have in your account in order to go long or short a futures contract. Now the exchanges are the ones that dictate what those costs are going to be. So those are constantly in flux. They move up and down based on the underlying futures contracts. So if it's an extremely volatile time, quite often they'll raise the margin requirements for investors to try to slow down the speculation and the volatility. And sometimes if it's slow, they'll actually lower the margin to try to stimulate more people coming in there and trading those futures and options or futures contracts. So they're the ones that change that and move it around. As of today's video, this is the actual margin for feeder cattle. The rest of this is basically made up. It's hypothetical. But let's say, hypothetically, that you opened yourself an account with $50,000 and you want to get long 1 April feeder cattle. Okay, you can do that. You just have to understand that you're going to have to put some money aside to do that. And this is how much money you're going to need. So you open for 50 grand, the 24.75 gets put over on the sidelines, and here's what you have available equity left over. $47,525, what you have left over. You can leave it in there in case the market moves against you. You can pick up other futures contracts, you could buy options, you do whatever you want with it. But the fact of the matter is, at least this much is put aside in order for you to trade just one feeder cattle contract. And here's the feeder cattle, their contract specs. It's a 50,000 pound contract, so every 1 penny move equals $500 in feeder cattle. That's FC is the symbol. So let's say you get long 1 feeder cattle at $1. These are all hypothetical too. It's about $2 right now, but anyways, just for easy math. You get long at $1, and the market moves your way 4 cents. Well, that's 4 times 500, so that's a $2,000 move to the good for you today. That's a good day for you. Let's say hypothetically the market goes the other way, and it goes from $1 down to 96. Well, now you just lost yourself $2,000 for the day. So these markets can really move, and it adds up quickly. Imagine if you had multiple contracts on. Right here it says infinity risk. Okay. Theoretically speaking, there's infinite risk to the upside if you were short a futures contract, because there's no end to how high numbers can go. Obviously, no one's ever lost infinity, but theoretically speaking, that could happen. And to the downside, feeder cattle can only be worth 0. I doubt that's going to happen either. Everybody loves their steak, so. But theoretically speaking, it could go down to 0. I doubt it. I think it would always have an intrinsic value. But so those are the hypothetical worst case scenarios in a futures contract. And that leads me to the next question I typically get is, how do you manage the risk in these futures contracts? They're so risky. Okay. Well, the answer to that, in my opinion, is a sell stop in this case. So let's say you're in this market at $1, and the market's going against you, 99, 98, 97. Comes down to 96 cents. Well, once it trades through that 96 cent barrier that you set, it turns into a market order. Now, a market order is available, trades at the next available price. So if you notice here, I've said you're risking 2,000-ish with a 4-cent sell stop in this case. And the ish is because you don't know what that next available price is going to be. Might be 96.10. Might be 95.80. Might be right at your 96 cents. You don't know. And that's why there's an ish there, because it depends on how fast the market's moving and a lot of factors, but you can manage it, just not as precisely as you might think. So that's how a sell stop works. Next question I typically get is, what is a call option? Well, a call gives the purchaser the right but not the obligation to buy the underlying futures contract for a specified period of time, in this case April, at a specified price, which is 104. Okay, let's say you went in there hypothetically and you bought this. You bought yourself an April 104 feeder cattle call, and it cost you 3 cents. Well, you know every penny is 500, so that actually cost you 1,500 bucks. Okay, let's go through this scenario again. So you got a call, you're betting higher. You buy this 104 call when the market's at $1. Boom, five minutes later it goes your way, 4 cents. Okay. Well, you're not going to catch the entire move like you did in the futures. In the futures market, it would have been a $2,000 increase. Options only catch a percentage of whatever the underlying futures market does. And this is what tells you what that percentage is going to be. It's called the delta factor. It means change. And I made this up too. So I'm pretending like this has a 25% delta factor. So that $2,000 move to the good, you're only going to get paid roughly 25% of that, which is $500. That's why there's an ish next here, because it's roughly, because as the market's moving up or down, your delta factor is changing. And there's other factors you have to think about too. Theta is one, which is time decay. Vega, which is your implied volatility, your volatility premium. So there's a lot of factors that go into pricing of an option. But this is the one you care about, delta, when it comes to figuring out how much approximately your option's going to gain or lose based on the underlying futures. And so in this case, let's say it went up $2,000, you got 25%. Well, your premium just accrued by approximately $500, so now it's worth $2,000. Conversely, let's say the market went against you. The futures went down $2,000. Well, now that option premium's only worth roughly $1,000 because you lost 25% of the futures move. So that's how it works. In this hypothetical scenario, the delta factor for and against you. Let's see. The next question I typically get is, what is a put option? A put gives the purchaser the right but not the obligation to sell the underlying futures contract for a specified time period and price. In this case, it's April 98-cent puts. So you can bet on markets going down just as easily as you can bet on markets going up. The risk when you purchase an option is limited to whatever you paid for it, your premium, plus whatever your commissions and fees were. So there's finite risk to the downside. You can't have any sort of margin calls or anything like that like you can in a future side. An option, you know your risk as soon as you put that option on, because your worst case scenario is it expires worthless and you lose the premium plus your commissions and fees. All right. Yeah, I think that's about it. That's what I want to cover today. If you have a question, you can give me a call. The website is tkfutures.com. My name again is Mike Smith. My contact information is there if you need to ask me some questions about these markets. Also, I wrote a book that's on Amazon called The No Nonsense Guide to Buying and Selling Options. As the title suggests, it's all about options. It doesn't really cover the futures at all. But if you're an option trader, it can be educational for you. You might also want to try one of our practice accounts, our demo accounts. The way they work is you download the platform and it gives you $50,000 in virtual equity, and you can trade that. You practice your trades with fake money before you put any real money into these markets, and I would definitely suggest practicing before you put real money into these markets. But I think that's about it. So hope you learned something. Hope you enjoyed it. Have a nice day. Bye-bye.